Hello and welcome to the next of our lecture recaps. This is a recap of our lecture on the group statement of financial position. So we know we have 5 workings to deal with for the group statement of financial position, and here's where we learnt them. We first of all reminded ourselves of some key group terms. Remember, the parent will be the entity that owns the other entities. A subsidiary will be controlled by the parent. We did a definition of control in our previous session, but just to remind us, control, remember, is when we have 50% plus of the shares, a majority on the board, or the right to appoint that majority on the board. The group financial statements brings together all the results of the entities in the group and presents them as one. And the non-controlling interest in there is the percentage not owned by the parent. So how do we prepare our group statement of financial position? Well, there were 5 workings, remember. The first one identified the acquirer and the acquisition date. So how did we deal with this? We read the question carefully. We identify the parent and the subsidiary and the percentage ownership. That will lead us to the percentage NCI. Remember, that's the non-controlling interest, the bit we don't own. And we check the date of acquisition because that would become important later on in our group questions. So we did this all in a working 1 for the group structure. It looked like this. We had the parent, the sub, and the percentages, and we noted the date of acquisition. We did that then for illustration 1. We then moved on to our working 2, and remember, it was to recognise and measure the net assets of the subsidiary because that's what we acquired. So we bought the net assets, i.e. the share capital and reserves, or some percentage of it. So we purchased that. We need to get the fair value of that. That becomes important later on. And we call that working 2. So what we did was we got the value of the share capital and the accumulated profits in the subsidiary, and we got those at the acquisition date and at the year end, and we got the total for each of those. So that was our working 2, and we then went on to do that for our illustration 1 in our workbook. We then moved on to goodwill. Remember, goodwill is an intangible asset, and it's basically the amount paid less the assets that were purchased. So remember, we talked about buying a shop, and if you buy the shop for a certain amount, well, you might pay more than the assets were worth. Why would you do that? Well, because of the customer loyalty that they may have built up, for example. The goodwill is what we call it. So we pay more than the assets are worth. We treat it as an intangible asset, and we do it like this. We take the amount we paid, the cost of investment, plus the fair value of the non-controlling interest. So that basically says, well, here's what the parent paid, plus the value of the NCI. That gets us the total value of the business, less the fair value of the assets. So total value of the business less the value of the assets gives us the goodwill. Because remember, that's basically what goodwill is, the amount it's worth less the value of its assets. Now, what would that be? Well, it would be an asset on the statement of financial position. So if you get a positive result in your working, it goes to the statement of financial position. But don't forget, if it's negative, if you got negative goodwill, that would be called a bargain purchase. You paid less than the assets were worth, and that goes to the income statement as a gain. Goodwill is never negative on the balance sheet. It goes to the income statement if that's the case. So that was our goodwill. We did that for illustration 1. We calculated it, and then we moved on to our NCI. Remember, this is the non-controlling interest. It's the bit we don't own, and we're trying to value it at the reporting date. We do it through working 4, which is the fair value of the NCI at acquisition, usually given to you in the question, plus the NCI share of the post-acquisition profit of the subsidiary, and we can work that out from working 2. So we'll see that in future workings that we do in future illustrations. And that gives us our NCI. So we did that for illustration 1 in our simple example in the workbook. The last of our 5 workings then was to calculate our group accumulated profit or reserves. So basically here we take the accumulated profit of the parent at the year end plus the parent's share of the subsidiaries post-acquisition profit, and we add them together. So we did it in this working. Parents' profit from the statement of financial position, so that's their retained earnings, plus their share of any profit the subsidiary has earned since we purchased them. So we did that for illustration 1. And remember, we'll see these workings over and over again in future illustrations. So we'll start off with the simple ones we did in illustrations 1 and 2. Lastly then, we prepared the group statement of financial position. Very simple process. Add across the assets, non-current and current. Add across them all. Even if we bought 50% of the sub, that still gives us control of their assets. So we add in all of the subsidiary assets, regardless of the percentage, as long as it's over 50%. We remove the cost of the subsidiary from the parent. We actually share that out in our working 3, so that's done. The share capital, well, we use the parent's share capital only, and we get our retained earnings from working 5. Add across the liabilities just like we did with the assets. We also bring in our goodwill and our NCI we calculated in workings 3 and 4, and that's our statement of financial position. So we did that for illustration 1. We had a pro forma to go through and fill in, and just make sure to go back and make sure you can do that illustration. We then went on and did illustration 2, which was another simple example. Again, make sure you can do it, attempt it again, just to be sure that you've got the basics done satisfactorily, because we will go on in the other lectures to build on all of this. This sets the basis. We then build on it throughout the rest of the course.